Welcome to this episode of Property Banter. I'm Michael Ležaja, and we're joined by my good friend and superstar accountant, Jeremy Iannuzzelli, where we discuss quality versus quantity, granny flats, how to read the market in 2025, and how to stay ahead. We also discuss the economy as well, so plenty in this episode. If you're a property investor, please like, share, subscribe, and we hope you enjoy. Welcome, Jeremy.
Mate, it is a pleasure. I'm actually feeling feeling very relieved, number one, because I've left 4-degree weather in Sydney and up here with the family, just enjoying a short break, and it's been beautiful. We've had 18-degree weather, 20-degree weather, sun shining in the beautiful state of Queensland, and I think this recording is just post Queensland winning the State of Origin.
Yeah, I know,
so
right? So
congratulations to them. It was a disaster by the Blues, but nevertheless, I got up here just in time to watch New South Wales lose.
I know, right? I got a lot of comments from my post yesterday about our loss.
Your Queen Street Mall post, that's right.
So I'm shit stirring a little bit, and it's come back to bite me, but it's all good. Mate, also the weather in Queensland, it's a little bit of a lie. Everyone assumes it's always sunny. It's not always sunny. But the main thing is that on your holiday, you ended up getting that good bit of weather.
I got a crack of weather, so it's meant to be.
100%, buddy. Let's talk about portfolios and how the majority of investors, our goal is to put us in a position, right, to go passive income, to pay off our home sooner, and to have more in retirement, right? Mm-hmm. So how that looks is different for everybody. And seeing a lot of portfolios, and I work on a lot of portfolios, people at a certain stage tend to look at different assets. Just like we were talking about now earlier there in the boardroom, we were talking about how, me and you were at one stage buying 9% yielding townhouses, and how that 9% yield looks great on paper, but after all the problems you get from the Logan tenant, and not all Logan tenants are bad, right? But out of all the problems, the issues, and fixing old properties, and the dramas, and the property management issues, and it doesn't actually, it's not as glamorous at 9% as something that's low maintenance at, let's say, a 5 or a 6. And then what I want to talk about is how that all ties in to what the end goal or what the end result is going to look like when we scale our portfolio, and whether or not you want to stick in, with residential, or you want to go commercial. Now, what are you seeing in your space right now? Because you look at a lot of people's books, right?
I think so. A couple of things to really discuss and mention is about the noise. So let's just talk about the really hot topics that are out there at the moment. Number one, it's quality versus quantity. There's a lot of professionals out there saying that I own 50, 100, 200, 300 properties, and they may well have, and I'm not debating or saying that there is any intention of a lie that they're making, but it comes with a lot of contingent liabilities. I'd rather have 10 great assets as opposed to 300 average quality assets because there's cost of maintaining a property portfolio. For everybody that's listening, when you're wanting to build a property portfolio and you think that your investment property will dilapidate the same as your own home, you've got it all wrong. I've owned my own home now. I've owned 3 homes, which we've called and been lucky enough to call our principal place of residence. Yep. And I can tell you now, I used to get angry. I used to feel frustrated as why my investment property, where I just spent a lot of money fixing it, 2 months later it's coming up and riddled with issues. Where my own home, it's the same age as that investment property, for argument's sake, and it is nowhere near or has nowhere near the level of issues. So I think that's important to understand the quality versus quantity debate. Yep. Second noise, that's out there at the moment is this rent investment strategy. Renting versus buying your own home, and we'll touch upon that as well. And then I think the third one is utilising residential property as a tool for retirement. What type of tool it is from a retirement perspective. And again, you have your financial planners that will weigh into it, people with experience, accountants, you might have other buyers agents, property advocates, specialists, wide range of different people have their different debates. Yep. But we'll start with, I think the first one, it's around quality versus quantity. Quality is always going to trump quantity no matter what it is. Quantity comes with additional council rates, water rates, contingent liability. Now, for everybody out there, a contingent liability is a liability that has not occurred yet, but will occur very soon. So if you've got a 1960s weatherboard house and you haven't changed the gutters or painted, the external of the property, you're up for a $30,000, $40,000 bill coming up very soon, whether it's fixing the roof, getting all the gutters redone, painting, fixing the window sills, because wood doesn't last forever. You've got to make sure you maintain it. So you've got to factor that in. If you've got 40 or 50 or 10 or 12 of these type of houses, especially the older ones, they will require substantial maintenance at some stage. And that substantial maintenance is not just done once in the property's lifetime, it's done many times. So where you're buying it, at what stage you're buying it, what condition you're buying it, will dictate and determine the level of cost you need to spend.
Yep.
And when you need to what you need to factor in is that if it's going to cost you 40, 50, 60 grand every 10 or 15 years to do this, and you're making 10 grand a year passive income, well, you've got to ring fence about 5, 6 grand of that every year to go towards that major cost.
Yep.
In 10 or 15 years' time. So that's something to consider. And that's why I always, from my point of view, now touching back on point number 3, I look at residential property as a tool to gain wealth.
To get started.
A tool to gain wealth. Now, wealth isn't necessarily cash flow. Wealth could be balance sheet, wealth could be a value, wealth could be maybe what you're worth as far as what you've just sold. At some stage or another, though, you need to, move wealth to a P&L, to your bank account, because, you see a lot of these billionaires, your Bezoses and your Elon Musks and your Gates of the world worth billions of dollars. But I guarantee if you went into their bank account, there's not billions of dollars worth of bank account. A lot of their wealth is in paper value, which is tied to the goodwill of their companies or their asset or property portfolio, for argument's sake, or share portfolio. So that's something to consider, and it's when to move that wealth from paper to now the P&L, and we've spoken about that in a prior podcast together as well. And I think that's still what's lacking. It's that understanding of that pivot, when to let it occur, and it's knowing and being in tune with your property portfolio. You need to know what level of costs are coming up. You need to know what exit strategy you need to be adopting at that particular time. And sometimes if you don't get it right, it does mean a huge amount of cost just to sell your property, not to gain extra value, but just to sell it. Because you and I often talk about it, walk into a property as a buyer's agent and me as just an investor. I look at a brand new roof. I'm not saying that, oh, wow, I'm going to spend $30,000 extra because it's got a brand new roof. I'll just say it's a tick. I don't need to do that roof for the next 25 years. It will help sell your property quicker, but it's not going to add extra value.
No.
What will add extra value is the emotive flowing juices that, a kitchen or a new bathroom or fresh smelling paint, herringbone floors. They're the things that really create the emotive juices in people to say, I'm going to pay extra. And the type of property you buy. I always, advise people all the time, and that's just me as an investor, now not as an accountant or I'm not a financial advisor, but just as a general investor, your owner-occupiers will pay more for a property. If your property is in a very investment-grade market aimed at purely only investors, then you will get investment-grade offers. Nothing wrong with that. But it's the people that want to buy that home to live in because it's the best street, it's near the new schools, it's got the best kitchen. They will pay $50,000 or $100,000 more because it's an owner-occupied market. And that might be the owner-occupied value. So you also need to make sure that what type of property you're buying and selling. A lot of people want to sell with a tenant in there. Nothing wrong with that when you're selling an investment-grade property. But when you're selling a owner-occupied grade property, you may not want a tenant in there.
No.
You may need to get that person out and sell it as vacant possession, and that's where mum and dad can come in and buy it and move into it straight away.
That's a fantastic point. And knowing what market you're selling to at the time of that market is very important.
Yeah, because you'll see in most cases, if you've got a huge buyer pool that's coming into a certain area that are all, say, investor buyer pools, and we've seen that in the East Coast investment markets moving into the West Coast or even middle Australia, you need that next wave of investors to come in and pay more than what those initial investors did. And if they're not, and if that next wave hasn't come, well, then your investors will tend to be left holding the bag, unfortunately, with no goodies in it. So you've got to be very conscious of what's happening around you. We've got movements in the economy. We've seen for the RBA meeting in the month of July, Michelle Bullock has left the rates on hold, and she's commenting and discussing about points that are happening around tariffs. Recently, Donald Trump's talked about tariffs relating to our mines and minerals, and also tariffs relating to our pharmaceuticals.
Copper through the roof.
Copper through the roof. He wants it now in America, so he's going to potentially tariff anywhere between 40 to 50%. Pharmaceuticals being exported to America from Australia, there's a 200% tariff attached to it. So she's very mindful of that. At the same time, she's very mindful of, you know, what's happening with our Australian dollar. If she cuts the rate too much, our Australian dollar might become weaker.
Yep.
All of a sudden, we're now importing inflation because everything we import into the country becomes expensive. Now, what's that got to do with property? A hell of a lot. There's a lot of things to consider when you're buying in a market. Who are the people buying in the market? When you're selling in the market, who are the people buying the property you're willing to sell?
And what type of asset you're buying?
What type of asset are you buying? Are you buying an asset, for argument's sake, that's heavily linked to, you know, a mining town? Are you buying an asset that's heavily linked to selling of pharmaceuticals and that whole town produces maybe, you know, the drugs that go to cure, you know, some type of illness? So it's very conscious of your surroundings.
Yeah.
And that's why I always say to people, you've really got to make sure you understand, well, what you're getting into it for, what's your exit around it. If you are looking at wanting to utilize that property for cash flow, is it actually going to give you any cash flow?
Yep.
Which leads you into the next point and topic of debate, which is the rent-vestment versus owner-occupied. And I'm always telling clients, you know, there's got to be the numbers that are done between it. If you're looking to rent-vest, that's not a problem. You've got to make sure that what you're paying in rent is significantly lower than what the cost would be to own. And if you're looking to own, well, you need to make sure that the costs of owning aren't significantly higher than the cost of renting. Typically speaking, look around the beautiful area of the Gold Coast, and there's some beautiful canals and waterfront or canal front property that are worth $10 and $15 million, and they're stunning places. But to rent that at maybe, say, $5,000, $6,000 a week. Now, as an accountant, I would die paying $5,000, $6,000 a week rent. I would be horrified in doing it. But if I was to do it, to get into and live in comfortably a $10 or $14 million home, it's the best decision.
Yeah.
Because the repayments on that could be, you know, $15,000 a week.
Yes.
As opposed
But if you're going to do that, you want to make sure that you've got a really good portfolio. Your business is doing whatever you're doing is set up in the background before you start to go pay.
Yeah, you don't go spending.
Just because you see value in the one thing, don't pay, you know, the entirety of your $200,000 wage towards a rent.
Yeah, you've got to have that opportunity there. You've got to make sure that what I'm spending here and what I'm saving there, I'm investing the balance of it. But, you know, for me, who lives in the southwestern suburbs of Sydney, and it's a very young, it's becoming a very younger dominated area. So a lot of, you know, younger people moving out of home and starting their families or wanting to live there. You know, when you look at the rent versus the cost of ownership, the disparity is not too much. And I think that's where you'll find that owner-occupier might be a better way of doing it, because the disparity is not too much and you get that capital gain tax-free and land tax-free asset when you sell it, as long as it's your principal place of residence.
That hasn't changed, Jeremy. 100%. You're right. Sorry to cut you off. That hasn't changed. That was the same back then. A lot of people want to just jump in and go own something, be in Bondi, or they want to be in Manly, or they want to be in Cronulla, or wherever they want to be, right? Back in the day when we started, that same section, which I come from, which is Ingleburn, Denham Court, right? That area, that was still where you needed to go because it was more affordable if you wanted to buy something. What are we, 50 Ks from the city?
Yeah, 45, 50 K.
45, 50 K from the city. You know, if you want to own, it makes sense. And from that perspective, you can't have your cake and eat it. You know, you got to go for the bang for buck. It's always going to be that way.
I like the comment you said, bang for buck, because I've always got this concept of frugality. And I think frugality is important because everything that we do as an investor, as a worker, as a business owner, frugality is not buying your mates a beer at the pub. That's a tight ass. Frugality is making sure that every dollar that you spend has a substantial value to it.
Yep.
You know, if that one beer that you want to buy at the pub is a reward and it's a refreshing drink because you've worked your backside off, then you do that. You know, if you want to buy that lawnmower because it's on special and it's going to last you 10 years, which is substantially better than the more expensive one, that's frugality.
Yes.
Making sure your dollar goes the furthest. And that's where, you know, you need to consider that rent investment versus the owner-occupied way of doing things. And the last one is, again, talked about more, and we touched upon it when we first discussed it, the whole property as a retirement strategy.
Yes.
There are comments
Let's break it down.
Yeah, there are comments out there that you can't retire in residential property, and to some extent, I agree with it. Now, I know you disagree.
I disagree, but it depends on the circumstance for the individual. Yeah.
And for me, why I would probably agree that some types of property aren't a great retirement asset. There's a great opportunity to build wealth in that asset, But I think, again, we spoke about a pivot earlier on. I think not many people pivot. And it comes back to that old comment of asset rich, cash flow poor. Land tax starts to become a cost. Council rates, repairs and maintenance, tenant issues, they all start to become a major factor, especially when you're at retirement and you've got no more cash flow or income coming in from other sources. And I think that's what people need to understand. You need that cash cow. Now, cash cow doesn't need to be a booming business making millions of dollars a year. I've seen very successful investors use their job as a cash cow, knowing that, Jeremy, I go to work, I do my 40 hours a week, and my 2,500 or 2,000 net comes in. I work my backside off, do a little bit of on the side jobs on the weekend, and I maybe get a bit more. But every week they can go to bed knowing, as long as their employer doesn't make them redundant or pays all their bills or everything like that, but every week they can know that they've got this certain amount of money coming in. That's a surety. You know, for anyone out there, again, listening, you know, if you've got an assurity of $2,500 a week coming in, and I can tell you now many small business owners don't, because small business, you know, you ride the waves and the emotions and the financial wins and falls, but that $2,500 coming in per week, that's gold. Because now you know that, hey, if I know what my fixed costs are and a little bit of my variable costs, let's call it arguably $1,000 a week, then I know I've got $1,000 to $1,500 a week that I can absolutely utilize for investing. And if I can build up a portfolio to say, hey, over the next 15 years, these particular properties might cost me $1,000 a week over the next 15 years, but they're going to grow at a compounding annual return of more than 7%, then, you know, I may have spent, from a cash perspective, $1 million. I may have got back $300,000 in tax. My net loss is $700,000. But what I've been able to gain with that net loss of $700,000 after tax from my assurity of the income that I was getting and that $1,000 a week going to maintaining my asset portfolio, my equity may have grown by $5 or $6 or $7 million, which is now what I was after. So it's cost me net $700,000 cash, but I've got $6 or $7 million worth of net equity position. Then that's when you start to look at and say, well, I'm now ready to leave my job. I don't have my $2,500 a week coming in religiously, where I have the assurity that that's there to pay the bills. So I don't have $1,000 a week that I can continue to maintain a property portfolio with. And that's where you may start to pivot some of those assets into other asset types. And we've spoken about that before on many podcasts. And I suppose that's where, you know, your role comes in of what those asset types are.
100%. Look, residential property gets you started. Fact. Even so much so, breaking it all the way down to getting a first homeowner's grant, getting into your first home, right? You can go rent vesting, or you can jump in and buy that. You could go out west and buy that and occupy a place and, you know, move into it for 12 months and live there and so on. And if you're a bit of a snob and you really need to live in Bondi and you really need to invest, then run down that strategy. But get into the market and get started. And that's why residential property is superior in terms of a superior asset to get you started if you want capital growth to eventually be able to do whatever you want to do, right? Because you don't just wake up and start running. You crawl, walk, run, right? So when you look at the fact that we can leverage in property and you can buy residential assets that go up, and if you buy the right data set areas, they go up in value and they can make you a lot of money. We were just talking about $200K in 6 months, right, in the boardroom. There's a lot of money to be made there, but then at that right point in time, like you touched on, when the time's right for you and where you're at in your life and your net worth at that time, if there is something better, then you've got to weigh up the opportunity cost. Not everyone can be 70 years of age running around doing maintenance on 20 investment properties, right? Because your retirement years, you want to travel, you might not necessarily be 70, I'm just throwing out a random age, right? But whatever you're doing, even if you're 30 and you just want to travel the world, right? You don't want to be doing maintenance because someone in Logan's just, you know, smashed one of the gyprock walls and, you know, whatever, right? You need to ensure that your money's working for you, but at the same time, you have minimal headaches. In life's going to give you enough headaches as it is. You don't need tenants, property managers adding to it as well.
Yeah, and I think the main thing is knowing what to improve on your property as well. A lot of people think just adding a granny flat to everything is the best thing.
There's a lot of those people out there. And the granny flat on the first one, Jeremy, sorry to cut you off, but doing a granny flat on the first property, that kills me.
Yeah, but granny flats, look, I do have many properties.
Stop that. Whoever's doing that, stop that right now. And don't listen to your buyer's agent if he's telling you that. Don't do the first property. No.
Putting a granny flat on everything is not necessarily the best thing. Sometimes you've got to understand, is that asset potentially for an owner-occupied market. And if it is, mums and dads don't necessarily want a granny flat plocked in their backyard. It sounds great as a novelty, but kind of wears thin and doesn't have that appeal.
Yeah.
But if it is an investment-grade asset, then yeah, granny flat makes really good sense. But coming back to what you said, you know, you might have 20 properties, let's call it 10 or 5. You've got to really identify which ones you do keep and which ones are the best bang for buck, which you said before. And you know, it's important as, you know, 10 council rates or 5 council rates, water rates and all those other things. But if you do granny flat the right type of properties where, you know, it may cost you $250 for a granny flat, you're getting $400, $500 of rent per week. Wow, where else can you buy a property where you're getting 7 to 10% gross yield? But there's no additional council rates or very little additional water rates and very, very little additional occupancy costs. Maybe insurance goes up a little bit, not a huge amount. That's where you're really getting bang for buck and then getting a cash flow strategy.
Yeah.
So it's important to note what type of asset you're looking at doing those cash flow plays on, what you keep, what you sell, whether you move into commercial investments, whether you move into REITs, real estate investment listed trusts, whether you move into, you know, very blue chip shares. Some people I know that have been able to retire very successfully, use property as a way to build wealth, and then went into shares because they just want to absolutely count the money. They don't want any headaches, and they're buying reliable shares in businesses where they're just getting a dividend either quarterly or half yearly. So it's important to really map that out. Know which ones you're going to keep, know which ones you might sell, know which ones are good cash flow, know which ones are great renovators, and diversify strategy. Diversifying strategy doesn't necessarily mean buying properties in different states. That property is something I've earmarked to reno and sell. That property, I'm going to make sure that I get a really good freshen up, and I think it's a very good owner-occupied property. Why? Because one of the best schools is just about to open up a primary school there. That property is a great cash flow property because it's a corner block. I can build a granny flat which will look like a separate home, and I'll be able to command the best presence of rent.
And everything has to tie into your portfolio, what your goals are, and ensuring that you've got good cash flow. So that is that little granny flat play alongside that renovator or that one that's got development potential, like that one we just did in Ipswich where we added a granny flat for 115K, 400 rent, right? Just a nice little granny flat addition, increase the yield. That's great for that. But it all has to tie in. And that's why I think you touched on earlier, doing an assessment on your portfolio regularly and ensuring that, you know, your plan's up to date all the time, you know.
Yeah, and we've spoken about in the past a business plan, you know, for every property, and you're not going to be successful without it. But, you know, those 3 things that we're hearing at the moment, which is, you know, your rent investment versus owner-occupier, quality versus quantity, you know, should we be, and again, the last one is residential investments going to be something that you can have at retirement? I think all the answers will have their pros and cons. Many people will have their own opinions and lean to which side of the fence they want to go to. But in the end, from what I've seen from very successful people, is that there is a sell down. They do focus on quality in the long term. And even me, I've transitioned as an investor to move from quantity. And I've made it very clear in a lot of earlier discussions I've had with, you know, lots of various podcasts that I wanted a number of properties. I wanted to get to 10 and I wanted to get to 20.
I remember that. I had that too.
I wanted to get to 30 and I wanted to get 50.
I want to do one a month, you know?
And that was it. And I was buying just anything that I could that was cheap, that the bank would lend me money to. And I realised very quickly how much it was costing me. I made some decisions very early to pull the pin and then focus much more on a quality purchase. For me, the last, again, 10 years ago, everything I was buying was less than 300. Now, everything I'm buying is, you know, 800, 900, $1 million plus. And the reason for that is I identify the level of quality involved in it. I identify the level of benefit that I'll obtain from it in the future. And I'm out of that, and sorry for everyone listening, but I'm out of that mum and dad market. When you start to really get into the higher levels of purchase prices for residential or for commercial, you're out of the mum and dad market that, you know, are really going to push their limit. You're dealing with maybe in somewhat more sophisticated investors. We all actually have the same price. We're all offering the same price. It's just who's got a better relationship with the agent, who's got better terms on the contract. I'm prepared to settle within 5 weeks. I'm prepared to exchange within 1 day. And I've recently done that. There was an office that I purchased in the southwestern suburbs of Oran Park. I got it at a good price, again, consistent with what everyone else was offering, but they chose my offer because I was able to settle within 4 weeks. So once you start to get up there and you start to be in the realm where everyone's numbers are exactly the same, it's all about then terms. Who can transact the cleanest way?
And that's how we win a lot of our deals. is understanding our terms, understanding what the broker's given us to work with. So I will literally push the broker if he can get it done, in 8 days. We'll push. We won't do a 21-day finance. We won't do a 14-day finance. We'll do an 8-day. We'll do a 9-day. We'll do a 10-day. Whatever we can do, we'll do to try and get it unconditional as soon as possible. That's music to the agent's ears. Anyway, I'm digressing and going off topic a little bit, but terms are so important because it's not necessarily. Everyone thinks it's the dollar. It's not the price. A lot of times it's the terms, and finding out what that seller wants is crucial in their position.
Yeah, sometimes they want an easy transaction, no headache. Sometimes they want things done fairly quickly. It's just finding out what they're after and then giving it to them. And again, that will give you the opportunity of getting the best
advantage.
deal. Yeah, so they're the main things to consider. And I think being now the FY26 financial year, it's going to be a year where, yes, we will see interest rates come down, even though Michelle Bullock has kept them on hold. But as interest rates do come down, a lot of that pent-up energy, a lot of that pent-up savings and demand will start to transact into the market.
Yep.
We're still very below where we need to be as far as dwellings per person.
Yep.
Immigration, while they've talked about it, again, pre-election and post-election of it ramping down a bit, it's still more and more migrants coming in. These people need to be housed, and there's just still not enough houses at the moment. So in Australia, we're going to be fairly insulated as a housing market, subject to any major financial crises. But even with our banks still being quite healthy, and we still have more and more people coming in, it's still going to drive demand. The only thing that would slow down and stop the housing market here in Australia would be a genuine recession. Now, even though we've had, by definition, recession, genuine recession is people losing their jobs, the market going backwards, the economy tanking. At the moment, things slowing down, and having negative growth per quarter that we've probably had over the last 4, 5 or 6 quarters, it hasn't been enough to really stop things drastically. It's kind of cleared a lot of the zombie businesses. It cleared a lot of the crap from COVID, the bad operators. The good ones are still doing well, and there's still more and more government jobs than ever before. So government's still propping up a huge amount of stimulus in the economy, although we did see Albanese come out recently saying that the private sector now has to do their job because you can't rely on the government to continue to prop up the economy. The private sector has some investment. But short of that happening and short of hundreds of thousands of jobs being lost, with interest rates coming down, and if we can maintain still our vacancy from a jobs perspective as low as it is, we're going to see a very strong property economy over the next 12 to 18 months. I don't think it's going to be at COVID pandemic levels because that was an anomaly of having ultra low interest rates and 600 billion with a B, 600 billion being injected into the economy as liquidity through their money making policies, cheaper loans, getting the loans out there, job seeker, job keeper, cash flow boost. There was so much money at that time being thrown around. When you have ultra low rates and a substantial amount of helicopter cash being thrown from the sky, that's going to cause a substantial amount of inflation, the largest amount of growth we've ever seen in such a short period of time. We'll see this time rates coming down. We won't see helicopter cash. So we're coming back to a normal market now. And that normal market means we'll have growth in some areas at quite high percentages concentrated, and then maybe lower amounts of growth in some other less concentrated areas.
And still for the investor out there, it's very important to continue to buy areas that have a really good data set, really good demand supply metrics, and are poised for growth, because there are different markets at different times, and we are going to see fantastic growth. It's going to happen.
You were saying something about ESERT, ESAT. What is that?
ERSAD, income relative to socioeconomic advantage and disadvantage. ERSAD scoring is Australian Bureau of Statistic metric, and I don't know, they've got quite a few different ways in which they gather this data. It's updated every 4 years. What it essentially does is when I analyze it on a data set, it tells me from an economic perspective how well they're doing, like financially how they're doing, right? So let's say a Double Bay, Bondi, a Toorak, Hamilton in Brisbane, these areas would have a 10 ERSAD. An area like Mount Druitt or Logan Central or Broadmeadows will have a 1 ERSAD. And that combined with affordability tells you how much a market can potentially run. So it tells you how affordable it is and how much that individual's earning and how much they can afford to pay on their mortgage. So it tells you that, hey, you know what, when you look at a 19 years to own, and that 19 years to own is a $600,000 property, 19 years to own for someone, 10 ersatz score, that tells you that those people can easily afford that going to 45 years. Now, when you look at that, that shows that it has an ability to grow. Affordability is very important for something to be able to grow. If something's not affordable, no one can buy. But that's one of the main things that I look at: super high rental yields, very low vacancy rate, and combined with really high ersatz score, showing that the people there are financially in a good spot. The market's done nothing for a while, so make sure you check that. And I'm running through a whole data set now and how I look at it, but make sure your demand supply metrics are spot on, and the area is poised for growth. And when you combine it all, it's fantastic. It's just like exactly what we did right now.
So it'll be interesting to see then what that ersatz score looks like pending interest rate cuts coming through.
Yeah. Well, you can't actually, because it's only updated every 4 years, and when it's updated, it only moves a little bit. So even with rate cuts, it's not too much going to affect the ersatz score, but what it's going to do, I think, and you correct me if I'm wrong, because you're obviously across this as well, but interest rates are like, I think you've actually used this term. I think interest rates are like pouring petrol on the fire, essentially, aren't they?
Look, it's an outdated tool.
You said that a long time.
Yeah, it's an outdated tool, to kind of bring an economy back to where it needs to be. But our problem is, and I think the best Reserve Bank governor has been New Zealand. People might disagree with me there, but he really squashed inflation very quickly. It did impact the New Zealand property market. New Zealand as a country, like you look at the amount of population they've got compared to us in Australia and what they produce compared to what we have, they've done exceptionally well. As an economy. Our Reserve Bank board have been pretty bearish across the board of bringing rates up and bearish now of bringing them down. So, and when I say bearish, a bull market or a bullish person is someone who's really confident, ready to run, head first like a bull, and a bearish market or a bearish sentiment is someone who's a little bit more reserved, happy just to kind of wait in the cave for a little bit, wait and see. So we've definitely had a very bearish board. Really wanting to see things materialize, and sometimes as rates, I think that's a reaction as opposed to getting in front of the curve.
Yeah,
that's going to be the challenge. I do think she should have dropped rates in July. I understand her metric and concept of why she didn't, because she wants to really wait and see what happens in America, and she's more concerned about an Australian dollar.
Yeah.
But those little triggers in the economy, with that ersatz score, it's interesting because it will change the income dynamic very quickly.
The updating of ersat and so on, that aside, the people losing income has a direct impact. So you won't see that on an ersatz score straight away. And interest rates in markets right now coming down, we're going to see those cuts as well. I think is going to be, as I was touching on earlier, that the pouring of the petrol on the fire, especially in markets that have no supply, that are in demand, that are super affordable, and it's going well. But you know what? You also mentioned how a genuine recession, I want to come back to this. You also mentioned a genuine recession. Explain to everyone at home what you mean by genuine recession. Is there a fake one?
Well, there is.
Explain to everyone at home,
because
and I did a video yesterday on corruption existing with NRL referees, right? But I want you to tell me, and for everyone at home, what the difference is and how that works.
A genuine recession, and there is a fake recession. It's just a name someone gives. You might have an economy, GDP, gross domestic product. Essentially, what we export, is it more than what we import, and how's the economy per capita going? Now, we've had a fake recession because we've had very small increments of the economy coming down. Our GDP, in my personal opinion, has been absolutely distorted because our export, which is money that we bring into the country, has not come from producing goods and services as much as it's come from selling our land and bringing in migrants, and migrants with a lot of wealth. Because when that migrant brings in their wealth from another country and then spend it now here in Australia, that really improves the GDP because we've got wealth coming into the country from other places. I think of it like a water bottle. We've now got water from other bottles getting poured into our own, and that fills up our bottle. But if you and I just have a bottle each and we just share the water between us and we have a sip in between, at one stage or another, we're going to have no water in our bottle left. We're bringing, migrants or selling our land or selling exported products and services overseas. It's bringing wealth from other countries in, and that's what makes a country richer. If you look at the 90s recession, we had job losses. We had no wage growth. We had high job vacancies. We're talking 6, 7, 8+%. That's why they call it the recession we had to have coming off the boom in 80s. And the 80s when TVs and people spending money on cars, it was very much almost similar to how we're living right now, well above our means. So yes, there are fake recessions. At the moment, we've been in a little bit of what I would call a fake recession because there's still money in bank accounts. It's actually not
noticeable to anyone.
There's still money in bank accounts. It's just that people are holding on to their money, looking at bluer skies ahead. Once they see the bluer skies, we'll start to see the economy pop again. But a genuine recession, if it does happen, you will see it because we will literally see what happened in the US. And we're very lucky because John Howard and Peter Costello, during their years of being Prime Minister and Treasurer, we had cash at bank. Not $900 billion, not nearly $1 trillion worth of debt. We had money in the bank. Australia was in surplus and we had cash in our bank, not $1 of debt. If there was debt, it was, same day debt type of thing. Now we've got $900 billion forecasted to $1 trillion worth of debt and we're running deficits for the next 10 years. So very two different economies. Interest rates when Howard and Costello were around were 7%. And the Reserve Bank at that stage, when they moved rates, they didn't move rates by 0.25. They moved rates by 0.5%, 1%. When the rates moved, it went up by 1%. When rates come down, it went down by 1%. People felt a material difference either better or for worse as rates move. Now 0.25, it's just you're sharpening the blade and you just don't know when it's going to stop. So genuine recession, we'll see mass, not huge amount, but we'll see mass unemployment. We're not talking about 90% of everyone on the street, but we'll see maybe 10%, 7% of people unemployed. Prices will actually come down. Money will not move. You'll see it. You'll see pain in the streets. At the moment, we've kind of had cushions the whole way since 2020. And those cushions just keep getting more padded and we've had a lot of government employees. So we're not going to see what we had seen in the past, especially in America during their GFC environment. But I don't expect to have a significant amount of helicopter money ever again.
The minor rate cuts show that they are comfortable. Speaking of GFC, I watched The Big Short yesterday. For those at home, if you haven't watched Big Short, that's a classic movie. Absolutely love that. It goes to show how bad it was. But we didn't really get that in Australia.
No.
Because I want to shift now to GFC. GFC in Australia, we had 8% interest rates. Was it 8.4 our max?
Yeah, give or take. Give or take.
8.4.
There is economies are linked to property. Properties are linked to interest rates. Interest rates are linked to sentiment. And sentiment is linked to, people's ability to earn money and spend money. So it is one big circle and that's why it's important as we go back to looking at all our various points of what we discussed today. The main thing is people need to understand you need to have a very holistic view. Your ERSAT score, what's happening in the economy, what's happening with tariffs. All the banks predicted 100% interest rate cut didn't happen. Michelle Bullock turned around and said we're cautious and looking more at tariffs. Donald Trump's talking about tariffs now on pharmaceuticals and mining. AUKUS deal's not going to be like it was, which may impact the South Australian or WA markets that were going to benefit off AUKUS. So there's a lot of things that will change. And you've also got to then factor in, what does that look like for me? Am I exiting, entering? Am I holding? Am I granulating? Am I cash flowing?
Yes.
You've got to take all that into consideration and bite the bullet. And do it.
And this comes back to team though. This is what I'm hearing as you're speaking. Everything comes back to team. Have a good accountant that helps you from a structure, taxation, planning perspective. Have a good buyer's agent that executes your portfolio really well because they understand it. Having that good team around you, finance broker, so on and so on, having the good team around you and having good advice is key. Whichever way you're going down, residential, commercial, whatever it may be. Jeremy, I appreciate you taking some time out of your holiday to catch up today and pop into the office, mate.
Thank you.
Good to see you.
Pleasure as always.
Thank you so much. We hope you enjoyed that episode of Property Banter with Jeremy Iannuzzelli. If you got a lot out of it, even if you didn't, just like and subscribe anyway. We appreciate the support and we'll catch you next time. Take care.